So Intel reported quarterly earnings and the stock is down 4%. You might think that Intel would be prone to any hit right now because the expectations are extremely low. Now, if you just look at the stock, you might think that it was a bad quarter, but actually it was a good one, a better than expected one actually, because they beat their own guidance that they gave us at the start of the year. But the issue here is for Q2 and well, for the longer term aspect, because the supply chain issues are not over yet and they actually expect it to continue until 2024, not 2023, but 2024. So add another year of struggles. Now, obviously with AMD and Nvidia reporting after Intel, remains to be seen if the issues are just Intel concentrated or it's now a broader problem. Now we do know that Intel is investing heavily in their business because, well, they've been doing nothing for years and years and letting AMD take more and more market share. But as you will see in this report, there are already some signs that things are moving into the positive direction. Now, obviously it's going to take a while until everything comes into place, but we can already expect some major improvements in the second half of the year. That's what they said during the earnings call. And as always, I'll talk about the earnings call at the end of this video. But first, let's have a quick look at this quarter's numbers. All right, so as always, they give us an executive summary. So they beat their expectations on revenue, gross margins, and EPS. Yes, even on gross margins. Executing on their strategy, creating more globally balanced semi-manufacturing. This is obviously something that will take some time and cost a lot of money. That's why they need the United States and Europe's CHIPS Act. But for the long-term health of this industry, this is extremely important. Now, when they say executing on their strategy, they obviously said that they will be delivering 5 nodes in 4 years. Intel 7, Alder Lake ramping, Intel 4, Meteor Lake booted Windows, Intel 3, Sierra Forest pre-pod wafers in 2022. And then these are all the segments of the business. Now, Mobileye will go an IPO. Intel Foundry business is something that will become extremely important for the long term of this company. Then AXG is basically GPU, a market where Intel, well, didn't really have any presence before, but they're on track to over $1 billion in revenue. They launched Arc A series. I'm very curious to see how this will perform actually. Then there's CCG DCIA, so CCG basically PC. This is data centers, and then NEX. Now, with regards to this quarter, so first up, let's look at what their outlook was for Q1. So they expected revenue to come in at $18.3 billion, down 1% year over year, gross margin to be 52%, and earnings per share of 80 cents. Now, what did they actually show us is actually a beat across the line. $18.4 billion, so a small beat above guidance. Gross margin of 53.1%, not 52%. That's a big deal. We're going to talk about that a bit later. And then earnings per share beating their own estimates by 7 cents to 87 cents. Now we're going to have a look at the client computing side, the data center side, which to me is a very important side, seeing that AMD and Nvidia are pretty strong there. And Intel, you will see they're actually improving on that already right now. So that's great to see. But first, I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 free stock picks from their popular product, Stock Advisor. Now, Stock Advisor has beat the market by more than 4x. So all you have to do is go to fool.com/couch investor to get your free 10 stock picks now. Alright, so Client Computing Group or CCG revenue is down 13% to 9.3 billion. Operating income is down 34%. And the reason is because of this lower revenue on ramp down of Apple CPU modem business, lower entry consumer education demand, and OEM inventory burn. And the lower operating income is basically because of the ramp of the 10 nanometer Intel 7 and investment in product and process roadmap. Now moving on to the data center and AI group, you can see that revenue is actually up 22% to $6 billion, but operating income is still down around 1% or so. Now, why is it down for 1%? Again, it's because of that 10 nanometer ramp and increased product investment offset by higher revenue. As for Network and Edge Group, which is NEX, revenue is up 23% to $2.2 billion. Operating income is up 51%, so that's quite nice. Now, that increase is partially offset by increased technology and product investments. And with regards to revenue, why is that up? Well, it's basically because of cloud networking demand and post-COVID transformation of the edge. And now for this smaller part of their business. So first up on the left here, we have accelerated computing systems and graphics, basically the GPU one. Revenue is up 21% on Alchemist and supercompute products, and higher operating loss on product pre-qualification reserve, production ramp charges, and robot investments, which is obvious. Then Mobileye, again, record quarterly revenue up 5% year over year. Operating income is down on increased investment in next generation products. And then IFS, Intel's Foundry Services, that's up 175% year over year on increased tool deliveries and increased automotive revenue. Operating loss approximately flat on higher revenue offset by investments in custom foundry. Now, with regards to GPU, CPU, data centers, etc., we're going to talk about the second half of the year because they do expect the second half of the year to be much, much better than the first one. And I'm saying this because you're going to see right here the full year outlook for this year, $76 billion in revenue, up 2% year over year, 52% gross margin, down 6.1 percentage points year over year, and then earnings per share of $3.60. That's down 32% year over year, but up 10 cents from their prior outlook. They still expect net capex to be $27 billion and adjusted free cash flow to be a bit negative. Now, if you actually look at those numbers, it's actually a positive because their Q2 outlook, gross margin down 51%, down 8.8 percentage points year over year, revenue 18 billion, down 3% year over year, and then earnings per share down 49% year over year to 70 cents. So you might ask how come they remain so positive on the second half of the year and they don't really change their full year guidance, seeing how Q2 is going to perform. So first up, Q1 overperformed, they overachieved in Q1, they said it themselves during the earnings call. Q2 is going to be weaker, as we've seen with the outlook. And then they expect the second half of the year to actually be a bit better because of the product ramp, whether it's GPU, CCG, data centers, etc. They said that a lot of products are ramping, and these new products that will have much better performance feature, some of that with higher costs, but also coming with higher ASPs, average selling prices, which will positively affect the business as well. Now, what are the risks here? Why is Q2 going to be a bit weaker, and why there might be a risk that the second half of the year might also be weak and they miss on guidance? So first up, they're no longer shipping to customers in Russia and Belarus. They're also the component of supply constraint continue to be a challenge with the most recent COVID lockdowns in Shanghai, further increasing supply chain risk and contributing to inflationary pressures. Now, with regards to the lockdowns in Shanghai, we've seen that with Tesla as well. If it's over right now, because we've seen that they've reopened a little bit, so they should be fine. But if, let's say, in a month or two, there's still another lockdown, then it's obviously going to hurt the supply chains, going to hurt every business basically that operates there as well, which will probably lead to a miss at the end of the year. And as a result, and one of the explanations for a weaker Q2, they expect elements of an inventory burn to continue in Q2, subsiding in the second half of the year. Although these headwinds have reduced their CCG revenue forecast, they expect CCG revenue to increase in the second half of the year as a return to normal seasonality boost demand, OEM inventory burn subside, and the ramp of our leadership Alder Lake and Raptor Lake products position us to compete per share. Now, they also said that the first laptops with the Intel Arc 3 GPUs are available now, and this will be followed by even more powerful designs with Intel Arc 5 and Intel Arc 7, along with desktop and workstation offerings later this year. So you might see why they are a bit more positive on the second half of the year. So there is something positive to look out for, and that's the second half of the year. Now, we're going to see already what will happen with that second half in Q2. Let's see if they can surprise us again in Q2. Maybe they'll have better than expected margins, even though I don't really see that happening with the ramping up of various products. Now, the fact that in this quarter, and this is something that Pierre Farragou mentioned during the earnings call, Pierre Farragou, you might have heard that name during Tesla earnings call and maybe on Tesla Daily's channel. So he was also surprised by the gross margins, and he asked why that is. Is it because of Intel 10 nanometers or Intel 7? And the question is basically yes, better than expected performance on that front. Again, it's going to take a hit in Q2, maybe even Q3, but overall, when the ramping up is normalized, let's say, we will see a much improved Intel, as we've seen with many companies that in the short term, let's say, are investing a lot, ramping up. We've seen that with Tesla as well. When you're ramping up, it's usually a bit flat, maybe a bit up, and then you go into the S curve, which is what I expect Intel to be doing. Again, by 2030, it's expected that the semiconductor industry will be worth over $1 trillion. And by then, I really hope that Intel has already figured out everything with regards to CPUs, GPUs, data centers, foundry businesses, etc. So overall, again, a neutral quarter, low expectations. They delivered this quarter. Let's see if they can deliver in the next quarter and then on their full year guidance. I'm gonna add some shares maybe sometime next week or so. What will you be doing with your Intel shares? Have you been adding? Have you been selling? Let me know down in the comments below. And if you enjoy this type of videos, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button, and I see you all in the next video. Bye bye.